All right, let's talk about the future, specifically the first quarter of 2026. Why then? Well, that's the moment when all the economic seeds we're planting today are finally supposed to bloom, or maybe wilt. Think of this as the delayed climax to the story we're all living through right now.
And really, this is the question on everyone's mind, right? After years of just insane economic turbulence, is early 2026 going to be the moment things finally start to feel, well, normal again? Let's dive in and see what the forecast is actually telling us.
Okay, so the main idea, the base case for this forecast, it all comes down to one crucial concept, the soft landing. You've probably heard this term thrown around a lot. The idea is pretty simple, really. You gently tap the economic brakes to cool off inflation, but you do it without sending the whole car skidding into a recession. It's the ultimate tightrope walk for the Federal Reserve. Now this is where it gets really interesting. Look at the timeline here. The big decisions, the rate cuts, they're all happening in 2025. But, and this is key, it's not like flipping a switch. It's more like a wave traveling across the ocean. It takes time for those cuts to actually reach the shore. Q1 2026, that's when the wave finally hits, and we feel its full force on the economy. Which brings us to the first major hurdle in our 2026 story, that final, really stubborn battle against inflation.
So on the surface, the news looks pretty good. The forecast for what's called core inflation, that's the one that strips out the crazy swings in food and energy prices, is projected to land somewhere between 2.4 and 2.6%. I mean, that is incredibly close to the Fed's 2% target. It almost feels like a victory lap, right? Like it proves the decision to start cutting rates back in 2025 was the right call.
But if it were really that simple, why would we even be talking about this? Is the fight truly over? Yeah, as you might have guessed, that headline number, it doesn't quite tell the whole story. And this chart? Wow, it just lays out the problem perfectly. While most prices are finally cooling down, there's one massive piece of the puzzle that's staying stubbornly high: shelter. We're talking rent, housing costs. This is a huge part of the inflation calculation. And because of the way it's measured, it lags way behind what's happening in the real world. And that creates a massive headache for the folks making policy. And that is exactly why we call it a tightrope walk. Think about it. If the Fed just ignores those sticky shelter costs and keeps cutting rates, they run the risk of inflation flaring right back up. But if they get too focused on that lagging data and keep rates high, they could completely choke off the economy and cause the very recession they've been trying so hard to avoid. It's an incredibly tough spot. All right, so with the Fed walking this tightrope, how does it all feel for the main character in any economic story? The American consumer. Let's check in and see how they're holding up as we head into Q1 2026. So, by early 2026, the average consumer is basically living in two different realities at the same time. On one hand, the good news. The job market is expected to be pretty stable, pretty normalized. But on the other hand, the bad news, households are still dealing with the hangover from high-interest debt, especially all that credit card debt that piled up. So here's the number to watch. There's this unemployment sweet spot between 4.0 and 4.3%. That's considered healthy. It's enough to keep wage pressures from getting out of control without causing widespread pain. But you got to watch out for that 4.5% number. If the unemployment rate ticks up past that mark, it's a huge red flag. It basically signals that the soft landing has failed.
And this table really shows that squeeze in action. So even if you have a stable job, your wage growth is probably slowing down. At the exact same time, those payments on high-interest debt are just eating away at your paycheck. You put those two things together, and it just drains your disposable income. It puts a real cap on how much consumers can actually spend.
And that all leads to a really fundamental shift in how the economy grows. If we're looking for growth in Q1 2026, we just can't rely on the consumer to go on a big spending spree. It's not going to happen. The growth has to come from somewhere else. And specifically, the thinking is it's going to come from business investment, now that interest rates are a little more stable and predictable. Okay, so if the consumer is tapped out and growth has to come from businesses, what does that mean for the financial markets? Well, it means it's time for a whole new playbook. For what feels like forever, the market has been all about a handful of giant tech stocks, right? The Magnificent Seven. But by 2026, with interest rates finally stabilizing, the forecast is calling for what's being called a great rotation. What does that mean? It means market leadership could broaden out to other sectors that are more tied to the business cycle. Think industrials, financials, that kind of thing. And that shift is actually a huge sign of confidence. It shows the market believes in a broader economic recovery, not just a tech story.
But even with this really positive rotation in the markets, there's a big structural problem lurking in the background, one that's putting a kind of speed limit on just how fast the economy can actually grow.
And that speed limit? It's something called fiscal drag. Here's the deal. Years and years of massive government spending have led to a really high national debt. To cover that, the government has to keep borrowing and borrowing. And that constant borrowing keeps long-term interest rates, like treasury yields, which are basically the interest rate the government pays, structurally higher than they would be otherwise. So it acts like a permanent brake on the economy, kind of watering down the full positive effect of the Fed's rate cuts.
All right, so we've walked the inflation tightrope, we've checked in on the squeezed consumer, and we've looked at the new market playbook. Let's put it all together. What is the final forecast for Q1 2026?
So here it is, the whole picture. The base case for Q1 2026 is looking like moderate investment-led growth, somewhere in the 1.5 to 2% range. We've got inflation that's getting close to the target, but it's not quite there because of that housing issue. Unemployment is right in that soft landing sweet spot, and those long-term interest rates, they're still a little bit elevated because of that fiscal drag we just talked about. This, right here, is what the new normal might actually look like.
Of course, this is just the most likely scenario. There are always wild cards that could throw a wrench in the whole thing. The first is a classic policy error. The Fed completely misreads that tricky shelter data, tightens too much, and accidentally tips us into a recession. The second is some kind of external shock, right? A big geopolitical event that sends energy prices through the roof and undoes all the hard work that's been done on inflation.
So when you look at it all, the path to a soft landing in 2026 seems pretty clear. But man, is it narrow, and it is absolutely full of potential pitfalls. So I guess the real question isn't just if we can get there, it's whether the economy, after everything it's been through, is really built to handle any unexpected turbulence along the way. And that's the answer we're all going to be waiting for.